Good evening, everyone. I hope you are all doing great and, as always, busy in your hard work rather than working, or rather, working hardly. I'm sure each and every one of you have been having good practice time, good learning sessions of late in the last few weeks. I think it's quite a gap since we met last, almost meeting after more than a couple of weeks, right? And I can see a lot of excitement. Josh is pretty high. Good evening, everyone here who has already kind of commented on the query panel. I can see the excitement. Prashant, Divya, Ashok, Ajay, Bhumika, and many more. Harmisha and Manish. So I think the last time we met was with a couple of sessions on cost of capital, and I believe you guys pretty much remember those aspects in terms of individual cost components and also the weighted average cost of capital. And I believe at that time itself I said that I will be covering three important areas with you guys. One is cost of capital, one is investment decisions, capital budgeting, you better say that, and then towards the end working capital management. Now today I would say, let me ask differently. Would it be correct to say that the topic we are here for today's evening is one of the three pillars of the financial management? What do you think? You guys agree with me? One of the three pillars. Can anyone tell me what three pillars I'm talking about? So we are looking at three different pillars of financial management, right? We talked about three decisions a financial manager need to take: financing decisions, investing decisions, and distribution decisions. And today we are in terms of discussing investment decisions. Right? So, and the learnings from cost of capital, financial leverage, ratios, everything, whatever you have learned so far, have pretty much be useful in these couple of sessions. Today, we will be spending a lot of time on conceptual grasping, and tomorrow, so we have back-to-back sessions, I believe. Tomorrow we'll be having a lot of practice as well. So, guys, to start with, I just have a quick question with all of you. I hope everyone understand that yes, investment decisions is all about, once you have arranged the finance, where do you invest, right? Or let's say we talk about for a running organization who's looking for a growth, and they have multiple projects in as a prospective opportunities. How do they decide, right? That's about the investment decisions. How to decide the best possible investment for an organization. So my question is, why investment decision, or in layman language, capital budgeting is important, guys? Why investment decision or capital budgeting is important? Can you guys tell me your opinion? Let's see who's responding first onto that. Constantly checking the query panel simultaneously, and very much amazed in the first 5 minutes, or the first 2 minutes. Interaction has been on the top notch as always. So what do you think, guys? Why capital budgeting decisions are important here? So the first response I'm getting from Partha Sarathi is long-term growth. Then Srinivasan says because it's a costly proposition. Okay. Okay. What about others? Okay, now we're getting so many responses. We want to get best ROR. Anmol says, Manish says for profitability. Akash says it affects the expectation of the shareholders. I think various responses. I think where I coming from is budgeting involves investment decisions involve, putting in your funds, right, which you had either generated or raised. And so basically we are talking about investing funds, capital, which is a scarce. Also, it is a pretty much a long-term decision, right? Long-term decision. And the most important, I would say that capital budgeting decisions are kind of irreversible. I'm not saying it cannot be reversed absolutely, but yes, it may not be reversed without incurring significant losses. So more responses: to maximize wealth, to lower costs and increase returns. Harmisha says to make proper investment, we can see the future growth, accurate profitability. Amazing. Ruturaj says, if investment is not right, there is no real use of doing anything. That's pretty much, I think, you guys are already doing in your shaping your career here while pursuing chartered accountancy. And Kiran says involving huge financial resources. Very well said. Smooth running of business, Sushil, and I guess similar responses coming in from everyone. So what we are looking here is, of course, the investment decisions per se that involves in optimum utilization of funds. And I think most of you guys were absolutely correct when you say that, okay, it maximizes the wealth of the organization. because we are talking about cost and returns. We try to opt for a capital structure which would have resulted in a lower weighted average cost of capital. But now it's the time to invest that rightly. And also when we talk about why it is important, as I said, it's very, very important because we need to understand there is a huge investment involved. It's a long-term decision, guys. And not only that, I think for me the most important point is this one, long term, and it goes hand in hand with irreversible. You end up having huge investments, and let's say what happens if after 6 months you decide, oh, I think this is not making sense to us, because you may not be able to take a U-turn unless you are ready to take a big hit of the sunk cost. So very, very important we understand that yes, these are very important decisions. And of course, while we will be doing understanding the process of capital budgeting investment decisions, we'll also understand that there are a lot of complexities will be involved in terms of assessments of various projects. For example, evaluating the future cash flows. We talk about the evaluating a lot of propositions which will involve making some assumptions, predicting the future cash flows from different projects, and so on. So the assessment itself of future, that is something makes it very, very tricky. Of course, uh, we all understand that yes, learning from the cost of capital, that each rupee involves a cost of capital, and hence you would want that rupee to be invested in the most prudent manner as it is possible. So that's why it's very, very important that we understand, that capital investing is very, very relevant here. Now let's understand, okay, while we know that, okay, this is important in terms of criticality, in terms of strategic planning from an organization perspective, let's try to go through with the process of capital budgeting, the steps the capital budgeting would generally evolve. Of course, it starts with planning, where we are talking about identification per se of potential investment opportunities. So everything starts with planning, right? Everything starts with planning. Whatever you do in life, we're talking about identification, planning, right? What exactly are the propositions and various opportunities with us? Once we identify, and mind you, when we're talking about identify, we generally map it. We generally the entire planning and evaluation, we always map with the strategic, you know, company strategy and the overall mission, right? And when we are talking about evaluation, we will have to compare those projects with each other. Now, a lot of factors can be considered when we are evaluating these proposals with respect to the returns each project will give us. Most importantly, in returns, maybe in absolute terms, maybe in terms of percentage, we will have a look at different methodologies. How do we evaluate? We'll talk about the methods of capital budgeting over here. And not only that, it's one more important aspect along with the returns, guys, is the timings, right? When are we getting the returns? What is the risk involved? So all those aspects will be considered in the evaluation stage here. And once we have done those comparisons, like, we will be discussing methods like net present value method, IRR method, discounted payback, different methods being used for different projects. The time will be key for selecting, choosing our cup of tea, choosing amongst the projects. There could be scenarios, uh, Weber very, very rightly said. Weber says vision is prior to planning, very rightly said. And that's why I said it has to be mapped with strategy. So once we are choosing the projects, we may be, facing the situation of, let's say, something like a mutually exclusive decision, like wherein we have to choose one amongst the other. We may have limited funds with us. How do we go about that? Even selection could be a very, very tricky in terms of, how do we rank different projects? All of that is coming our way in today's session, and of course tomorrow's as well. Now, once we have selected, so in theory, what we will be doing in terms of what we are understanding, how we make those decisions, what does a financial manager has to do, we will be talking about till selection. But in practice, once we have selected a project, it's very, very important. The last two steps is implementation, actual field work or kurukshetra, where the actual work will start, where the actual responsibilities and people having accountabilities will do their respective roles, and then followed with the control and review. I think very, very important. I think whatever you do in life, control and review, unless and until you have a monitoring tool in place, you do not, have a control of the situation in terms of whether you did a right decision or not. What are the improvements which you have to, make sure in the future decision making as well. Sahil says, what is sunk cost? So, Sahil, we will talk about the sunk cost. Sunk cost is something which is already incurred and will not be impacting your decision. So, any cost which is incurred in the past and it's not going to make any change will not be considered for decision making. We will talk about that. Don't worry. Okay, so this is your entire process of capital budgeting is, and depending on the situations, you may have different, you may be, posed with the different types of capital budgeting decisions also. And I'm pretty sure some of you may be able to correlate with that with respect to whatever theory you would have read in your study materials already. It's specifically when we are talking about distinction of the capital budgeting decisions, either on the basis of firm's existence and or basis of the decision situation. So what do you mean by this? I would actually talk about this right side first. I will talk about the basis of decision situation. I think this is more of a routine stuff when we talk about companies. Remember, we discussed like in the cost of equity, also the companies doesn't distribute the entire amount as dividends. They also retain earnings for the purpose of expansion in the form of retained earnings. We discussed marginal cost of capital and all. So as a routine operations, companies will always plan to invest in more and more projects to expand, to grow. Hence, these decisions, basis of decision situation, will be kind of those decisions which will come your way in the way of your growth, like mutually exclusive decisions where you may have some funds but you are faced with a different proposal. The only fact is, when we talk about mutually exclusive, let's say if you're talking about proposal A versus B, either you will be able to do A or B. Acceptance of one proposal will automatically reject the other one. Mutually exclusive decisions. Accept reject decisions. Sometimes we are talking about, it's for example, we are talking about a kind of a proposal coming in from a vendor. I talk about whether you want to do manufacturing or something, or accept a proposal from a vendor to purchase something from outside. So you may need to do an independent evaluation, compare which is less costly or which is giving you more returns, and that will be an accept reject decisions. And then also there could be a contingent decisions wherein your immediate course of action may decide the future requirements of the funds and maybe future investments involved. So these are, I think, more of operational stuff. But I think when it comes to criticality, if you see the left hand side, basis of firm's existence, what do we call about replacement and modernization in today's world? Gone are the days where we were talking about, okay, there's a lot of competition. You have to absolutely make sure that always stay ahead of the competition. I think you have to, in fact, be 10 steps ahead of the competition these days. You can't even wait for the competitors to react. You need to ensure that, you know, you need to be always ahead of your game in terms of the technological obsolescence, specifically artificial intelligence and so on. The way the technology has come up in the last decade or so in terms of the modernizations, making most of the old systems redundant, has required companies to take the calls of replacement and modernization. And that's why we are clubbing that under the firm's existence. Because if you are not moving ahead, you can be out of the game. Expansion. Again, this could be actually clubbed under both. We're talking about like firm's existence. You don't want to grow big, stay as is, you will be automatically gone, right? So you are forced to grow and grow in terms of if you have to continue to capture the market share. Diversification, all are kind of independent in terms of thought process, but if you see, unless and until I offer something different from my competitors, how can I expand, how can I grow? So diversification could also decide your firm's existence as well, right? So a bit of understanding in terms of the capital budgeting decisions, capital budgeting process, and that sets the right tone of what the capital budgeting is, what are the investment decisions all about. Having said that, do not forget, we are talking about investment of funds, hard earned funds, either by the organization from the internal operations or raised by the from the external sources of finance. Could be either ways. So now we talk about some important aspects, guys, of what all is involved. The most important aspect when it comes to the evaluation stage. So remember, we were talking about the evaluation of the various alternatives, right? We discussed why capital budgeting is important, long term, irreversible. And then the decision itself could be complex because we have to evaluate certain proposals, which in itself involves some kind of assessment of future cash flows. Wherever future is involved, we are always talking about a uncertainty element, guys. And that's why it's important for us to understand that, okay, what are the various project cash flows that may be related to with respect to different proposals we have. Let's say a company is planning to set up a new factory and they have choice of three different locations, a new factory, and they have a choice of three different locations. You may consider factors like, what is the cost involved at each of the locations, what is the market size, estimated revenues and cost, what are the relevant cash flows we may be having, and that since the project may relate to a longer term, and we have to make a decision today. One thing that will also come to our a, a table is called as a present value, as in discounting those future cash flows to the today's value, and that's where our weighted average cost of capital will also come to point, right? So let's move on and decide and discuss mutually in terms of what are the project cash flows here. But before I even proceed, I want you guys to respond me on the query panel, and let's see who goes first. Why we are focusing here on projected cash flows and not projected earnings, guys? Why we are focusing on projected cash flows and not projected earnings? Let's see who responds. I'm repeating my question again. Why we focusing on project cash flows and not projected earnings, or earnings projected for different alternative proposals here? Okay. So the first response coming in, let's see whose response is the first one here. To consider the cost of earnings. Akash says to consider the cost of earnings. Okay. What about this? Cash flow. Okay. Very, very good answers, guys. I think Srinivasan, that's a very, very good perspective. Srinivasan says cash flow is non, I'm just assuming what you wanted to write is non-manipulative, right? Non-manipulative. I would like to go beyond your terminology. When Srinivasan says that it's non-manipulative, what he's trying to say is that earnings are based on accruals. Accruals are based on estimates, which may involve some management assumptions. Hence, some kind of a biasness may be involved. Very, very perfect answer. Uh, Rajendra says to know the future inflows for outflow made. Okay. Mamta says to know the company's liquidity position. Very nice. So focus is on liquidity. Of course, profitability will come into picture as well. Uh, Anindita says cash flow is on the base of inputs. Benefit for depreciation. Sahil says, okay, Sahil, yeah. So Sahil, we will consider I will talk about that concept called tax shield. Any non-cash elements which could result in any kind of a tax saving or a tax liability, will consider that. We also call it as an indirect impact of those items. Harmisha says cash flows involve both income and expenses, which gives us actual income earned by the company in way of actual cash. Harmisha, I would like to combine your and Srinivasan answer. I hope that makes a perfect answer here. Right? So your and Srinivasan answer is a perfect answer, where since we are talking about investing in terms of cash, we want liquidity. When will we get those funds blocked gradually or at some point of time, right? To know the rate of return and accept better offer, Partha, very nice. Ninath says cash flow means actual money coming in, but earning cannot be notional or can be notional. Very right. A lot of answers, guys. Harish, projecting earning doesn't provide clear picture of existing earning. Harish, I think that yes, the more important point is in terms of the assumptions, the estimates, accruals, right? The earnings would be based on the accruals. Here we are focusing on the funds being invested, outflow, initial outflow versus future inflow. So Ruturaj says cash is more appropriate. Earnings may have other elements. Very right. So good, guys. I think Sushil, very nice. So overall, I think all the answers are absolutely correct. So basically, what we are all agreeing on here is that earnings involve some components which could be based on, I would not use bluntly the term manipulation, but yes, estimates, biasness, those are the terms which could be associated. Whereas cash flow is something purely based on receipts and payments. So also the impact we are talking about, guys, relevant cash flows. The word is relevant cash flows, or you can call it as a incremental cash flows. They're considered as, again, I think if you see the brackets here, the timing of cash flows doesn't match the accounting profits, and investment decisions require the initial investment, because you may record a revenue initially, who knows, the cash flows are following in the next year. So you have to be very careful about having an apple to apple comparison here. More answers coming from Bhumika and Ruturaj. Yes. So now for calculating these project cash flows, there are a lot of factors to be considered, which are summarized here for your reference, guys. I'm sure those of you would be going through your study material. You would see, all these factors mentioned at different places, but I've tried to summarize for you guys. The most important point is depreciation. Like someone said, I think Sahil said about depreciation. So depreciation is a non-cash, but we still, are we considering depreciation here? See, it may be a non-cash expense, but mind you, if it's a non-cash expense, it reduces your taxable income. And if it is reducing your taxable income, it gives a tax shield here. Tax shield. Make sure we understand that as per Income Tax Act, we follow the block of assets. That means, and we will talk about this separately on a slide, where we will discuss that yes, in a terminal year, gain or loss in the last year of the project, gain or loss will only be if the asset is the last asset in the block. So we'll talk about that separately. But yes, depreciation, it's a non-cash. I hope everyone understands the depreciation point, that we consider the tax savings due to depreciation. So let's say, let me give you a simple point here, and let's see who responds. Let's say there is a depreciation expense of 50,000 and the company has a tax rate of 30%. Can you tell me, guys, how much how much amount would be relevant here for the perspective of project cash flows? I can help you by three choices or four choices: 0, 50,000, 15,000, and 35,000. 0, 50,000, 15,000, and 35,000. Let's see what are the responses you guys are giving me. Misha, you are almost being captured in the net I tried to spread here. I intentionally gave those options. Think before you answer, guys. 0, 50, 15, and 35. Only couple of answers received yet, guys. What about others? So I think I agree with majority of the answers. I think majority of the answers are giving me 1, 5, 15,000. 1, 5, 15,000. Guys, see, the point is, let's say that my profit before depreciation, interest and tax, we are talking about, let's say, is 200,000. And if we reduce the depreciation here, so we are moving towards a lesser profit before tax. So don't you think my tax liability would be less now? I will be saving some tax due to this 50,000. So the relevant portion will be only the tax shield, 50,000 into 30%. That is 15,000, which happens to be the answer given by the majority students. 15,000. Sushil, right? So I hope everyone understand now. 15,000. I think some of you were just got confused because I gave you an option. 35,000 will not be considered now. See, at the end of the day, 50,000 entirely is non-cash, right? But since it is reducing your taxable income, and hence your tax will be lesser by that, so it's 15,000 will be considered. In fact, before I even go to the next one, let me show you a couple of ways of calculating the tax shield, which I already have in the next pages. So you guys can see now. I think it would be good to discuss it now itself. So she'll 50,000 into 30%. So let's look at this another example, guys. Let's look at another example. Those of you did not understand. So she'll answer was 50,000 into 30%, simple. But on my screen right now, you guys are seeing two methods here, or two alternatives. Method one, method two. Let me go very slowly here. In method one, we have earnings before tax and depreciation is 50,000. We are kind of ignoring interest here. Less depreciation of 20. My earnings before tax is 30. And the tax is 30% is 9,000. That means profit after tax is 21. So my profit after tax or my net income is 21. What I'm doing here is I'm adding back the depreciation because it is a non-cash item. I'm adding back a non-cash expense here. So my net cash flow is 41. Net cash flow is 41. I want a confirmation on method one first of all. Those of you who are clear on method one, can you please confirm on the query panel? Yes or no? Or if there are any doubts, please let me know your question. I, as per my experience, most of the people prefer method one due to its straightforward process. I got a couple of confirmations. Thanks for that. What about others? Is method one clear to everyone? Very nice. Thanks for confirming, guys. Kadambri, Tanishka, Vinod, Anmol, Parmisha. Thanks, Sahil. Let's go to method two. Now, before I even talk about method two, I would say that, okay, sir said that non-cash expenses will not consider, will only consider the cash flows. Okay. So what I'm doing here is I'm ignoring depreciation altogether. I'm saying, okay, earning before tax and depreciation, assuming that there is no other non-cash expenses, 50. And I'm straight away calculating tax on that 50,000 as 15,000 and my cash profits become 35. Wherein I completely ignored the depreciation. But most of the tax laws, Indian Income Tax Act, US taxes, UK taxes, in which we have a Her Majesty Revenue and Customs and all that, every country's tax law would allow depreciation as a deductible expense. Now, I am seeing here, and let me connect these 2 points, and I think this is more Srinivasan, your point will be automatically covered here. Let's see this, guys. How much is the tax without depreciation? 15,000, right? But imagine, because the depreciation is an allowed expense, how much tax we actually have? 9,000, right? 9,000. I am calculating tax 15,000, ignoring depreciation. So, what are we saying here, guys? What we need to consider in this case is ignoring the depreciation. Just give me a second. Yes. So we are saying ignoring the depreciation here. We are talking about the taxation amount of 15,000. But since we have a tax savings, we have the actual, tax liability is 9,000. So how much is the saving due to depreciation? We call it as a tax shield, 6,000. So we add that 6,000 onto this 35 and we get 41. So you are getting the same answer here. But I'm absolutely okay. I think a lot of people have already confirmed that method one is better. We are good with method one. I'm okay with that also. I'm okay with that also. Just that you need to know that, okay, you know, sometimes, based on the information given, you may not need to go for a method one to save some time. So you should know the quick shortcut as well. Everyone with me on this? So Srinivasan, your point that cash profit includes depreciation but not tax shield. I think you understood your point now. That cash profits, in the cash profits, we ignore depreciation, but we added tax shield separately. I'm just checking with everyone else. I think Janta is agreeing that, okay, method one is easier. So I'm okay with that. That's okay, whichever method. But my objective is to ensure that you understand both the methods. Prashant, second method, what we have done is we have ignored the depreciation initially. we have ignored the depreciation initially. Let's say if there was no depreciation, my profit after tax would have been 35,000 cash profits. But now we know that, okay, because of the depreciation is a tax deductible expense, it would have reduced your tax liability by 6,000, because your tax liability is not 15, it is 9. 15 to 9, saving of 6,000 is added here. Saving of 6,000 is added here. That's why we are getting a 41. Akash, I think let's keep that point to different questions. I think Akash was having a question. Uh, is there any benefit to method two? Akash, it depends on the format of the question, where let's say you may not want to prepare a income statement and you have to have a quick MCQ, let's say, or where you want to save time. So it all depends on, yes, absolutely, Ruturaj. I agree. Okay. Harmisha, yeah, I think I just answered that. I think your question and my answer was pretty much simultaneous. You're asking, can you explain what is actual different concept when applied? So we'll see if there are any questions along with that, right? So it will result in time saving. Okay, guys. So I think the first point which I have been trying to explain, and you guys were absolutely awesome uh, in terms of understanding. Okay, I have a couple of questions, guys. Just give me a second. Sahil says, first method, why depreciation is not 30%? First method, Sahil, 30,000 into 30%, 9,000. It's 30% for both, right? Anmol, uh, tax 9,000 ही है. Even for the method. So Anmol has a question, sir, what amount of tax we need to pay? Guys, please tell me whether it is method one or method two. Will your tax liability change? No. Tax liability is anyways based on the taxable income, which allows depreciation expense, right? So basically tax liability is your, basically after taking care of depreciation. Although I know some people may ask me, sir, depreciation as per the tax law may be different. I'm not going into the different discussion of deferred taxes here. That could be a little complicated for you guys right now. Mohammed, the question will not tell you to, which method you need to follow. Based on the information, whichever method you feel you are comfortable with, you can implement that. Okay. And if you're asking me, if your question was, if we have to apply method two, how do we calculate depreciation tax shield? Guys, I'm repeating it for everyone here, that a simple question, if let's say you have an MCQ in which they give you a depreciation amount and they're asking you the tax shield, like I gave you. Let me go back to the previous slide. I also gave you that question. Depreciation is 50,000. What is the tax shield? Simple answer is depreciation into tax rate, please. And if they are giving you the question is outsmarting you guys by telling that, okay, the tax depreciation is this much, depreciation as per the tax laws is this much, then use that amount. Okay. So first point is we have kind of covered in very, very detail. Factors to be considered, coming back to the slide. Depreciation tax shield will be considered. Depreciation tax shield will be considered. Opportunity cost. Guys, please understand the word here is relevant or incremental. Whatever points you are discussing here is keeping in mind that we are talking about incremental or relevant cash flows. So the second point automatically becomes relevant because let's say I want to start up a project in another factory which currently has been let out. Do you agree with me? If I were to start a project, I have to get that factory vacated. That rent which I was getting would be an opportunity cost because that is a foregone benefit. I would not be vacating that factory if I'm not starting that project. So opportunity cost becomes relevant automatically. Everyone okay, guys? I think second point is clear to all of you. Why opportunity cost is important. Okay. Also, I think someone asked me earlier about what is sunk cost. As I said, sunk cost is something which is already incurred. Sunk cost will something which will be irrelevant. It is already incurred in the past. As the word says, sunk. It's already incurred. It's not relevant for us. It's not relevant. Biggest example, if you're talking about replacing a machinery, my historical cost of the existing machinery, which I purchased 6 years back, is not relevant for me. That was incurred in the past. Right? So sunk cost is not relevant for us. Working capital. Now, working capital is very interesting point. It could have different shapes. Let's say because of a new project, if I have to increase the working capital, would you consider the working capital? Yes, incremental working capital would be considered. Incremental working capital would be considered. Very interestingly, let me give you a very, very interesting example. Let's say there is a project of automation and you want to try the automation project for, let's say, next 3 years. In the case of automation, there is a highly likely that your working capital may actually reduce. In case of automation, you want a lesser working capital now. So it may result in a reduction of working capital as well. But make sure, guys, the most important point in working capital decision or working capital, you know, consideration is that if you introduce additional working capital initially, then you have, when you are evaluating a project, let's say project is for 5 years, if I'm including a working capital at initially at time zero, today that we are starting up this project, this is additional working capital. At the end of the project, you may not need that working capital. So at the end of the year, at the end of the 5 years or the project life, you need to ensure that could be a release of working capital. What I'm trying to say here is it could be an additional working capital initially. And when we are talking about last year of the project, at the end of the project, you may want to release that working capital. Now, how do you decide? Of course, question will tell you. Question will tell you that let's say this working capital specifically is required for the project. So you may want additional working capital initially, and at the end of the project, you can have that as an inflow. That what I'm trying to say is initially it could be an outflow, and later on it would be an inflow here. This is also important for us, and we will talk about working capital discussions a lot. Of course, we will have a different discussion on working capitals later on as well. Working capital management is altogether a different topic. And now we talk about allocated overheads, guys. Allocated overheads, as the name suggests, maybe we're talking about some corporate head office overheads which are allocated to different projects or different departments. Generally speaking, the allocated word tells me that irrespective of the project, if these overheads are incurred, I should not consider it. But what if addition of the project expansion may increase my overheads, then incremental overhead will be considered, not the existing overheads. If some overheads are already incurred at the cost as the head office, they are just allocating those overheads to different projects. Do not consider that. But if starting of a new project involves additional overhead, that needs to be considered, and that is something in line with our understanding of incremental or relevant cash flows here. Next point, operational savings or costs. What is this, guys? Operational savings or costs. Now, let me ask you, and we will talk about this. Lot of practical questions on this. A typical investment decision or a project may involve either additional profit or reduction in cost. So let's say if you are talking about replacement of machinery, you may have a situation where your cost may go down and hence net income will increase, or it is anyways additional expansion to your current operations where you will have some revenue, income, some expenses, net incremental to your earnings. Either ways, that will be your most important core heart of the project. Heart of the project will be your operational savings or cost reductions over the next 5 years. But the most important thing is we need to consider them, of course, net of tax. Mind you, we have to kind of do tax implication wherever it is required. So if it is a reduction in cost, it will increase your income. Hence, it will be increasing your tax liability and your reduction in cost will be reduced. If it is savings, it may bring in additional liability, additional taxes, savings may reduce. So the benefits will be reduced to the extent of taxes involved. Sushil had a question of what do you mean by opportunity cost? Sushil, opportunity cost is the cost of the next best foregone alternative. If I am using this space for this project versus I was letting out a particular space which on which I was earning a rent, that becomes an opportunity cost. You know, if someone is attending a session here versus having a nice evening with the friends, opportunity cost is the evening with the friends. But you guys are very intelligent. You know that okay, attending this session here will give you a future benefits, right? Anyways, last point, guys, or rather second last, because last point we'll talk about the financing cost as well. Additional investment at any stage has to be taken into account. What we mean is sometimes the nature of the project is such that every third year, every fourth year, let's say a project involves 50 lakhs on which from which 40 lakhs have to be invested initially, 10 lakhs after 3 years. So if that is the case, that additional investment at any stage will be taken into account. Taken into account. Now, guys, Tanishka had a question. Sir, please explain the allocated overheads again. Tanishka, let's say, so what is overheads, right? Which are indirect costs. Let's say company is incurring a 10 lakhs of overhead, 10 lakhs, and which is they are dividing those 10 lakhs in four departments, right? I'm just taking an example here. Now, because of an additional project, if there is no impact on those allocated overheads, you will not consider anything. But those were anyways incurred, like a sunk cost. But let's say because of the project, you are hiring a couple of more supervisors, and that allocated increases from allocated overheads are not 10 lakhs now, but 12 lakhs. So that additional 2 lakhs will be taken into account. Then, I hope it is clear. Harmisha says, will you explain operational savings again? As I think operational savings and cost reduction is distinct. Absolutely. I said that could be both the things, right? I gave the example, Harmisha. I think you missed out on that. That let's say if you're talking about upgrading and machinery, that will be a cost reduction, right? Cost reduction. In terms of operational savings, you may also having a scenario where additional project, additional stream of business, new product line, and you have a separate stream of revenue and expenses. So those will be contributing to your additional earnings as well, right? And of course, operational savings would have impact on cost as well. Okay, I hope Tanishka, Hamisha, all are clear. Everyone is clear on this. Srinivasan says, can you please explain the importance of efficient capital allocation and the success of a company? Srinivasan, I think that is a very, very generic question, and that is what we'll be doing in the next couple of hours. That's what we'll be discussing, right? That's a cap. So, answer to your question is, a smart investment decision or a very effective capital budgeting planning is the answer to your question, right? Because you know that, okay, and also I think part of the answer I will be telling you where you will be ranking the projects in line with the strategy. Okay, great, perfect, superb, guys. I think, okay, the last point which we need to talk about here, and there is a little bit of a background to this, guys. Before we go to the last point mentioned with respect to the financing cost, I would like to talk about this that, okay, when is that you need to take this investment decision? Is it today or is it in future? Is it today or is it in future? I believe today itself, right? So you may be posed with different investment evaluation alternatives. You have to evaluate them and decide today rather than future. Most of the projects may involve initial outflow. Most of the projects may involve initial outflow and future earnings, future inflows. That's what will happen. Now, to ensure that you take apple for apple comparison, okay, let me give you another example. Let's say you are, when I always, I very, very, you know, often I use this example phrase, apple to apple comparison. So when we talk about apple to apple comparison, we talk about iPhone. Let's say you take an example, right? You go to a shopkeeper who says that, okay, either you pay me a 1 lakhs now for an iPhone, or Let's say you pay me 9,200 per month for next 12 months. So this is an option the shopkeeper is giving me. 1 lakh now or 9,200 for the next 12 months. Maybe a smart financial management student would try to evaluate if the cost of borrowing, let's say, is 10 to 12%. This guy is actually giving me two apples. I have to just pick one apple because both the apples are same here. Either I pay 1 lakhs upfront or I pay interest and pay 9,000 or 9,200. You guys agree with me? Both options look very, very similar to each other, right? I'm not going into the exact calculation and interest rates and all, but this is the kind of schemes we get, right? So that means what we're trying to say is if I have to do that evaluation today, I will have to discount. I'm talking about time value of money now. I will have to discount the future cash flows. I have to discount the future inflows to the today's value, so that we have to discontinue. That is something we'll be discussing anyways in the discounting techniques. In your curriculum, we will talk about non-discounting and discounting techniques. But if we have to take wise decision, we have to consider the time value of money, because the time value of money considers cost of capital in terms of WACC. We will ignore, we will ignore any financing cost associated with cash flows. What does that mean? For example, if I typically look at a income statement and I pick the last line net income. If I look at a typical income statement, I pick the last line net income, and from the net income, guys, I have to arrive at cash flows. I'm sure we are talking about a very common adjustment in terms of adding back any non-cash expenses like depreciation, like method one we did. So if you were to calculate your cash flows from the net income, will you add the non-cash expenses? Yes or no? Guys, do you agree with me? From the net income to arrive at the project cash flows, I have to add back the non-cash expenses. Along with that, I will also add back if there is any interest element given over there, even if it is a cash outflow. Why is that? This is what we are discussing here, that we have to exclude the interest or dividends because we will be anyways discounting the future cash flows. We will be discounting the future cash flows. Reducing my cash flows, please understand this. Okay, let me ask you a question. I'm asking you two questions right now. Question number one, what will be the impact of discounting the cash flows? Will it increase the cash flows or will it reduce the cash flows if I discount? If I discount my future cash flows, will it increase or it will reduce my cash flows? What do you think? Let's see who responds to this. I hope everyone understands here how to discount, right? Opposite of compounding, right? 1 upon 1 plus r to the power n. So everyone says it will reduce the cash flows. It will reduce the cash flows. Very nice. Question number two. If I were to allow interest in income statement, interest expense, will it reduce the cash flows or it will increase the cash flows? I think interest expense will also reduce the cash flows. It will reduce the net income. So do you see that it is a double whammy, double impact? If I were to consider the net income and only add back the non-cash expense and then discount those cash flows are already after interest expense, and again I'm discounting. It's a double discounting. To avoid that, to ensure that we are not considering the double impact of the financing cost, we will add back the interest net of tax to the profit after tax, along with any non-cash expenses as well. So very important that we understand the last point, that financing costs will be excluded, will not be considered. Do not worry if you are not 100% clear at this time. Let's say if you're 80% clear, I'm fine, because we will see this element in practice also. How do we exclude the interest cost? Simple point. If you see, if in the question they are giving you a projected income statement for the next 5 years, you're taking the net income, you're adding back the non-cash expenses as per the method one, you also add back the interest net of tax, because you will be discounting those cash flows. You'll be discounting those cash flows anyways, right? Does that make it a logical correlation, guys? I hope yes. That makes a logical correlation for everyone. And do not worry, we will look at most of these aspects. We will repeat, guys, when we reach the question stage, right? Abhita, I'm just kind of giving you a little bit of a pretext, setting the right stage. When we'll start, when we'll start the practice, we will consider each of these points. Srinivasan, I am okay with that. Srinivasan says, then why don't we take EBITDA? The only thing is then you are moving ahead to method two. You're, because what we talk about, reduce the tax and then takes the depreciation tax shield. So if you're following method two, Srinivasan, you can take EBITDA. Getting it? Because you will anyways EBITDA, you will apply the tax and then you will have to take the depreciation tax shield. So that's why I told you guys that you will be giving answers to your own questions now. Side says projects cash flow says use of the capital make money and reduce tax. Uh, you can say that. You can say that. I would not say reduce the tax, but yeah, you take the net of tax impact. Okay, everyone with me on this? Okay, now we understand. Okay, all of these could be important for taking into consideration the project cash flows. But as we discussed, different projects, long-term projects, a long-term capital budgeting decision would be spread across number of years, 5 years, 7 years, 3 years, right? Long-term projects. So that means these cash flows will be spread across the over span or over the term or the duration of the project, guys. Yes or no? That make it more important to kind of bifurcate for a better analysis. We will spread this. We bifurcate these cash flows over the stages, various stages of the project. For example, I'm talking about initial cash flows. Initial cash flows. Now, I'm not using the word outflow or inflow. Could be anything. So, initial investment would always be generally coming initially. Cost of the new asset and its installation would generally be an outflow. Investment in working capital and savings in working capital. Now, look at this. Ruturaj has a point. I am confused at one point. If I'm the one who's receiving the interest, I should add it back. And if I'm the one who is receiving dividend, Ruturaj, we are not talking about receiving the interest. We are paying the interest, right? You're talking about the payment, right? You're talking about the payment of the interest or payment of the dividends. You're the one who will be talking about raise. You would have raised the finance, right? Either through equity or debt. Dividend you anyways would have not considered at the net incomes level. So Ruturaj, I think you have to swipe the table, right? You are on the other side. We're talking about from a company who has raised the funds and investing now. Okay. So yeah, coming back to the stages of cash flows, guys. Now, in terms of the stages of cash flows, the first one is initial investment, cost of new asset and its installation. That's your outflow. Then I specifically talked about this, right? Investment in working capital or savings in working capital. Now, most projects would have additional working capital requirement initially. Exceptional projects like automation, something which may reduce your working capital requirement. So it could be savings also. But make sure that once the project is over, this is where most of you remember your mistakes. Some of you have done this capital budgeting in earlier or in other curriculums or in graduation, right? I think that's the common thing. Do not forget, at the end of the project, you do the reversal of the working capital. If it was an additional working capital initially, you will release that. If it was a savings of the working capital initially, you will reinstate. If it was a savings of working capital, reinstate to original level. So we are talking about initial cash flows right now, but I'm just kind of linking the working capital point that that's something you have to consider at both the aspects. Now, guys, in initial cash flows, when we were talking about relevant cash flows, I hope you guys remember we discussed sunk cost. The historical cost of the present machinery or old asset is not relevant. But guys, there could be a possibility that the replacement may involve sale proceeds of the old asset. So that will be a cash inflow, no? Net of any tax. That depends on the block of assets, any gain or loss having any tax impact. So sale proceeds of asset, if at all any tax impact, net of that will be an inflow here. Gajendra, you have a question of why so, but you did not mention which with respect to what point. I'm just assuming, is your question with respect to working capital? Anmol says, sir, please explain working capital concept in initial cash flow. Anmol, if you are involved right now in 3 factories, but you are also planning to start a 4th factory, Anmol, would you be needing more working capital? I guess yes. But let's say that factory is only you plan to run a factory as a special project for let's say 5 years. So at the end of the 5 years, when that project is over, you don't need that extra production line. You do not need that additional working capital. So initially it will be an outflow, and later on it will be an inflow. So let me write down that in case you have a working capital which is initially an investment, which will be an outflow, later on release will be inflow. but but let's say if it is so Gajendra, I think I answered your question, right? It will be release of working capital if the project is ended. But if this project is ever going, then it will not be there. If you want to continue that factory till eternity, of course you will not consider that. On the other hand, if there were savings in working capital, that could be inflow. If let's say there was an automation trial project for 3 years, and then you have to reinstate the and trust me, there is no confusion for you guys, because whatever case scenario examination will give you, whatever the question you guys will see, that will mention about working capital. You just have to be careful that you take into account whatever the information is given to you. You will not have to make any assumptions about it. The question will give you, right? Okay, guys. I hope everyone is clear in the initial cash flows. Now, throughout the project life, we talk about when the project is ongoing. This is where we are looking at interim cash flows. As the project keeps on running, we are talking about new project profit after tax plus non-cash expenses. Of course, we are excluding the financing cost also. Replacement, in case of a replacement of machinery, it could be a incremental revenue or savings in expenses net of tax, because we will see these questions also where you will compare, okay, what is the current revenue, current cash flows in the current condition of my production. And if I want to update or replace my machineries, what will be the changed scenario? So we'll only look at incremental revenue or savings net of tax. Sometimes there could be additional working capital between the project also. Let me just draw you a graph here. So let's say this is a working capital and the project is for 6 years. So you may have a project where working capital is more of a required in a step format. So every second year you need additional working capital. So that could also be a possibility. And then we have a terminal year cash flows. In the terminal year means we are talking about last year, end of the project. Mind you, terminal year is also in year, right? So if the project is for 6 years, 6th year is also year, right? We're talking about 6th year. So your whatever the interim cash flows were there, it will be there for the 6th year also. And if let's say that asset has to be sold, their salvage value, net of any tax impact on gain or loss, that will also be considered. Srinivasan says, why we are not considering free cash flows in the place of cash flow? Okay, a very, very good question, Srinivasan. The free cash flow is a different concept which we consider for valuation or acquisition decisions. But for capital vesting decisions, so because in the free cash flows, you keep aside the working capital requirements and any capex requirements also. I hope you understand. So you're anyways evaluating the capex projects, right? How can you use the free cash flows? So that is what we are discussing right now. Harmisha says, is it possible that there can be saving in working capital for interim cash flow? Could be anything, Harmisha. That's what I'm saying. Possibilities could be anything, right? So again, automation example could be stretched to include your point. So my request would be for working capital, just read the question and follow the instructions. Make sure if it is impacting more than one stage, just take a note of that. Why I'm telling you guys is, working capital in my experience says that sometimes students get excited. They know that something is mentioned in the question. You take into account in the initial year, but they somehow forget to mention that in the last year. If at all there was a release of working capital or something else. So that's the point in terms of the stages of working capital, guys, or stages of cash flows rather, not working capital, right? So now we talk about. I hope everyone understood. When we talk about in terms of the cash flows net of tax, you can have a quick look at or a quick glimpse on this particular slide, which doesn't even consider the tax impact here, right? But yes, you are not sure, what format may be given in a question. Just an example, which is based on a sales or a contribution. And then you are just, kind of taking the cash inflows after tax. But whenever there is a financing element involved, then, you could have a different income statement. But this is just a simple example here. Now is the time 1 hour into the discussion. And let me ask my favorite question. How is the Josh? How is the Josh? Are we all ready for seeing some capital budgeting techniques? Is the Josh still high? Super high? Because abhi tak, what we have done is we have created a base, we have created a foundation, we have understood the terminology, we have understood what all will be considered, what will be, or what all will be involved in a capital budgeting decision. Now is the time to go for some capital budgeting techniques here. Everyone doing good? Just checking on everyone for a moment. I hope you guys are in a super mode. Already I can see a lot of questions here. Srinivasan, I would not confuse you guys with that. Because see, if you're saying operating cash flow, then there would be investing element in terms of the initial outflows and investing, right? Or a financing also. So it's like let's not go into the cash flow terms. But yeah, from that project, cash flow relevant to a project. Kadambri says super duper high. Very nice. Super. So now we talk about capital vesting techniques. I'm sure most of you would agree with me that when it comes to maximizing the return of the shareholders or the wealth maximization, it called, it's important that we talk about the most beneficial investment here. And of course it could impact our strategy a lot in terms of not taking a right decision. In the meantime, Bhumika had a question: why are we considering profit after tax plus non-cash expense in interim cash flow instead of a initial cash flow? Non-cash expense in interim. So Bhumika, because the point is that is during the project. Na? Interim cash flows means, like, let's say a project is for 5 years. So first year, second year, third year, fourth year, 5 year, fifth year. So year zero will be your the initial outflow, as in like at the beginning of the project. Year 1 to 4 is the interim, and fifth year will be terminal year. Mamta is very honest. Mamta says high to nahi, but decent Josh is there. Okay, very nice. Great. I hope Bhumika, your point is clear now. So yeah, so that you can see there are two broad techniques we have mentioned here. One is a traditional non-discounting techniques, but one is a discounted cash flow techniques. And I am absolutely with you guys that yes, the most important are these ones, because these considers the time value of money. Having said that, we will spend a little bit of time on the non-discounting techniques also, because A, this is in your curriculum. B, you should know, because something of a non-discounting technique can create a base for your discounting technique. Like, we have a method called a payback period. So you have two methods here: payback period in a non-discounting, and a discounted payback in the discounted techniques. So but the most important ones, if you ask me here, in terms of evaluation and practicalized from a question perspective also is a net present value, profitability index, IRR, discounted paybacks. These are, very, very important and frequently tested as well. But yeah, discounted payback is dependent on the payback period. Or it stems down from the understanding of the payback period. So let's start with this. Let's start with the payback period first, guys. Now, as we say that this is one of the technique to evaluate a project, let me throw the ball in your court again. Let me ask you guys. You need to tell me, when would an organization use a technique like a payback? Don't even consider right now कि payback है, discounted payback है. Don't even worry about the time value of money. But when would a organization be evaluating projects in terms of payback and not in terms of profitability? Can you tell me when would be the scenario? What could be the situation where you are talking about some considerations of a payback rather than profitability? Let's see the responses. By the way, that was a question to you guys, right? I'm hoping you guys are mentioning your responses on the query panel. When there is a cutthroat competition in market, Hamisha says when it thinks it may not make profits or so, Turaj. Okay. I think you're starting to think on the same page, but still there is a little bit of a gap which I would bridge actually. What about others, guys? What about others? Few people are more responsive than others. I would request others also to give your answers. Okay, now I've got plethora of answers, guys. Super. Investor recovered all money, Sahil says. Ninat says when they are investing from retained earnings, not from borrowed funds. Okay. Mary says certainty. Mamta is giving me discounted payback means present value. Yeah, Mamta, don't worry about the discounted. I'm saying ignore the time value of money for the timing. My point was, and I would like to take something from each of your answers, guys. All of you are right in part of your answers, but we just combine the right part with you guys. What happens here is Ruturaj says it must just break even, or then you're talking about when I got more profitable investment from Manish. Okay. Okay, let me answer this, guys. See, the focus is right now, I'm not even debating about discounted or non-discounting. I'm saying that we are talking about the word payback. Don't you think there there could be some amount of risk in the project where the duration could be high and management would be considered about the when you would be getting your original amount back rather than the returns? So payback will be like, yeah, Tanishka, absolutely awesome. So Tanishka and Sahil, those two specifically mentioned when the money will be recovered by investors. So when we are talking about recovery of your investment, when your focus is on recovery of your investment, then the payback will be considered when there is a risk involved or a longer projects, right? So payback period of an investment is the length of time. Look at the definition is the answer actually required for the cumulative total net cash flows from the investment to equal the total initial cash outlays. That means the time in which the inflows will result in plowing back the amount invested here. Yes, Bandip. So very, very nice, right? So here we are talking about two factors needed to calculate what is the initial capital involved and what is the after tax cash flows later on. And then something called as a payback reciprocal, which is something which is nothing but close to IRR, which is one upon a payback period. It's a close approximation of the internal rate of return. So don't worry about this right now. We'll talk about that later. When we talk about this IRR, we will touch base this later on. Now, right now, how do I calculate a payback method or payback period? How do I calculate the payback period? There could be two scenarios. One, my future or the project years would be resulting in a uniform cash. That means my assumptions, my estimates are such. I'm having uniform cash flows every year, same amount of cash flows every year. So it's very simple mathematics that you pick up the initial investment and divide that by annual after tax cash flows, and that will give you the payback period. Mind you, do not worry about the discounting as of now. We are talking about non-discounting. So payback period is initial investment upon annual after tax cash flow. That's it. That means if a project is costing 10 lakhs here, if the project is having a 10 lakhs here as an initial outflow and yields annually a profit of 3 lakhs after depreciation of 20%, but before tax of 50%. So how do I calculate the payback period? Now, since it is given 3 lakhs after depreciation, but before tax, what I will do is I will reduce the tax first, right? We're talking about a taxation to be reduced as 150. As per your method one, you guys told me to use method one. And then I will add back the depreciation. Depreciation is straight line, 20% is 2 lakhs. So hence I'm getting 3 lakh 50,000 is my annual after tax cash flows. I'm getting my denominator now, 3 lakh 50,000. So 10 lakh divided by 3 lakh 50,000 is 2.86 years. It's a simple vanilla example. Vanilla example means with no dry fruits, with no flavors, with no choco chips. Now we are not talking about ice cream. We are talking about the uniform cash flows. I hope everyone is doing good here. Simple example, just to explain the concept of what is the payback. But what if the life was so rosy, right? This is a situation where you have a uniform cash flows. But do we have a uniformity? Generally, may or may not. So what happens, guys, when the cash flows are not so uniform? What happens then? Do not worry, we will talk about that as well. In case the project is having uneven cash flows, what we need to consider is we have to calculate cumulative cash flows after tax and then consider in which year my investment is plowed back. So this is a very, very good example on your screen right now that a project is having a 2 lakhs of cost and yields the following after tax cash flows, right? After tax cash flows. So they're talking about 1 lakhs, 80,000, 60,000, 40,000. First question, is it uniform? No, it is not uniform. It's different cash inflows coming in. So what I'm doing is I'm doing a cumulative year. 1 lakh for the first year. Has my project cost of 2 lakhs recovered? No. 80,000 for the next year makes it cumulative 180. Has the project cost recovered now? No, not yet. We are very close because the project cost is 2 lakhs. Third year is 60,000, which makes my cumulative as 2 lakh 40,000. Now my eyebrows are raised that as soon as I see 2 lakh 40,000, hey, I have probably not only recovered my project cost, but also gained some benefit out of it. So that means I can say that it's right here in the third year where my payback is happening. But how do I calculate this? How do I calculate this? So payback is in third year, but how do I calculate, guys? So what we do is we go back to 1 year before, like up till 2 years. Up till 2 years, I had recovered 180, right? Up till 2 years, I had recovered 180. How much more money I needed? How much more inflows I needed to recover? 20,000. I needed 20,000 more. How much cash inflows after tax actually I have earned in the year three or I'm projecting to earn? 60,000. So the amount yet to be recovered upon that year's cash flows is the fraction we are looking at, which is giving me 2.33 years. 2.33 years. I need a quick confirmation here from everyone. This is clear or not clear? This is clear or not clear? Normal payback is clear to everyone. Uneven cash flows. Any doubts, please let me know. quick confirmation would be appreciated in the query panel. If you guys are absolutely okay till now, very nice. Anmol had, sir, please again, what Anmol, what do you want to understand? So in the cumulative way, in the second year you have not recovered, in the third you have over recovered. So that means somewhere during the project term, in the third year you have recovered your cash flows. You have to arrive at by what point? So in the third year, you have 60,000 cash flows, but you are only requiring 20. So we are talking about 20 upon 60, one third. So if let's say the operations are uniform, so it may be something like 2 years, 4 months. So that's what we are looking at here. Mamta says, why cash flow? Because Mamta, we have to consider the cash flow. Na? This is the capital budgeting techniques. Okay, so advantages, easy to understand. I think yes, that is from your response. Everyone is clear, simple to compute, high level of estimate. Okay, so I think the most important advantage is that you get to have an idea in terms of the length of the project, when you are getting a capital back. But I think the biggest disadvantage here is that it ignores the time value of money. It ignores, okay, there are two things. One is that it ignores time value of money. It's not apple to apple comparison. We are having the future cash flows added today. And second disadvantage, which will also be the disadvantage for discounted payback, it ignores profitability. When we are evaluating, guys, please try to understand, please appreciate. And let me ask you this question actually. Let's say project A and project B. If project A is having a payback period of 2.33 years and project B is having a payback period of 3 years, which project will you select? If you were to decide based on payback, project A gives you 2.33 years, project B gives you 3 years. Which project will you decide? A or B? A or B? Tell me, guys. Waiting for responses. Payback for A project is 2.3 years, B is 3 years. What does the Janta have to say here? So Janta as a majority tells me that almost like more than 20 answers suddenly. Everyone is project A, right? But did you wonder one thing? None of us, including me, we did not even see what is the profitability of the project after the payback. What if project B was rendering the returns even for the next 7 years, and the project A was rendering returns only for the next 3 years? So that is the drawback. We are ignoring, we are ignoring the profitability, cash flows after payback. That means we are outrightly rejecting the long-term projects. They may be more profitable. That's the drawback. That's the drawback here. I hope everyone with me on this. Before I go to the another non-discounting technique, I would like to cover a discounted payback here itself. So it's good that we can cover the discounted payback along with the payback. I think that is very, very logical way of doing things. You need to tell me in terms of discounted payback, if I were to ask you a question, let's say, you guys need to tell me true or false. The discounted payback period will be shorter than the payback period. With the same for the same project, for a same project, discounted payback period is shorter than payback period. True or false? Then its payback reciprocal is kind of IRR. We will discuss IRR later. Like if my payback is 1/4 years, then we are saying it's an approximate consideration that IRR may be around 25%. So that's where the IRR will have your NPV as a zero. Okay, I'm coming back to my question, guys. Let's see what are your answers. For the same project, we are having a discounted payback as a shorter than payback period. Is it true or false? I have half Janta saying true, half Janta saying false. In fact, I'm just seeing right now, very, very interestingly, many of you are saying me that it is true. Many people say, I think true lag raha hai, something like that. Okay, let me break the ice here. If I were considering, a discounted payback, guys, what do you think? And let me use the space on the right. If I were using discounted cash flows, will these numbers be higher or lower? The first year 1 lakh will be, let's say, something like 91,000. Second year maybe around 65,000. Taking an example, guys. Third year maybe around 43,500. And the fourth year would be, let's say, around 24,500. Discounted numbers will be always smaller, right? Because you are multiplying these cash flows into 1 upon 1 plus R. So if the discounted cash flows will be lower, will it be taking more time or less time to recover my initial cost? Will it be taking more time or less time? Tell me, guys. Just give me 5 minutes. We'll give a break right now, but just give me 5 minutes for this. So that means the payback period will be higher then. That means I was false. That my statement was false. Discounted payback period will be higher. What do you think, guys? Guys, everyone with me? Everyone clear? All okay till now, guys? Hence proved it will be higher. More time will be required, right? So while we are discussing payback period, I'm kind of quickly touching base upon the discounted method. That is one of the discounted method because it is related to payback method. That's nothing but your, in terms of your discounted payback. So what is this discounted payback, guys? Discounted payback, it's definitely a better version here of a payback period as it discounts the cash flows to their present value. So here it's more a realistic version. We are considering the time value. The calculation is very, very similar to the cumulative approach because we are talking about discounted cash flows, but it will always be a longer period than non-discounted payback because the discounted values will always be a lower numbers. So make sure we understand that the payback method will be shorter, giving you a shorter period, and a discounted payback will be giving you a higher or a larger time frame in terms of understanding. Because if you see these numbers which I have taken in this example, of course, you have to, the next step is, first step is you discount the cash flows. Next step is you calculate the cumulative value. So I can see my cumulative value is like almost at the end of the 3 years, I'm reaching 2 lakhs. If I see cumulative, year one, 91, year two, 156, and then 43,500 is 199,500. It's taking slightly longer than 3 years. Slightly longer than 3 years here. If you see these numbers, everyone doing good? So what we have done is we have started working towards evaluating the capital budgeting techniques. We have started with the non-discounted techniques, but parallelly I have covered one discounted technique with you, which is your discounted payback. And one method more is there in non-discounting, that is accounting rate of return, ARR. It can be challenged due to its nature of the calculation. We will discuss that, but I think it's 7:25 p.m. and you guys deserve a break for your fantabulous participation in the first hour and a half. So let's take a 10 minutes break here, guys. Please freshen up yourselves, drink water, tea, coffee, grab your drink, and we will be pretty much back to the action within 10 minutes, guys. See you on the other side with the same participation, with the same energy levels. See you in 10 minutes. Okay, great guys. Welcome back. I hope you guys had a much needed break here. Everyone is back with the same energy levels. So let's resume our discussion on the non-discounting techniques, guys. I told you that there's a second one. Second method apart from the payback method is your average rate of return or accounting rate of return. Now I have a problem here in terms of the nomenclature when we say that okay, it's the accounting rate of return. Hey, didn't we start discussing the capital budgeting cash flow based on the cash flows? Accounting profit accounting income would involve accruals, estimates, some kind of a bias, and that's you can see the calculation also. Average annual net income upon investment. So numerator is average annual net income over the project life. So we are not talking about only cash flows here. That's the problem. And even the investment could be a very different, right? Investment could be different calculation in terms of, are we talking about the initial investment only? Are we talking about the average investment over useful life? Or in terms of calculation of ARR also, there is a way that we can calculate each ARR for each year separately and then probably average all the years. Now, if we are talking about additional working capital, now this can be a slightly confusing to some of you. We're talking about if additional working capital is needed during the project in addition to initial, then see the point is here we are saying what is a prerequisite? Additional working capital is needed during the project in addition to initial investment. Average investment uh, would be half of initial investment minus salvage value, and then we are adding back the additional working capital. Now many people ask me that okay, and very logically also, why we are adding the salvage value again after reducing it? Can anyone answer this? In the formula we are saying, like we are talking about average investment. Average investment is like, let's say, beginning your initial investment throughout the investment divided by 2. So we are saying initial investment minus salvage value divided by 2, but we are adding back that salvage value again. Any thoughts why? I think some of you may be able to answer this easily. Some of you may find it a little tricky. So let's say we talk about a particular project here. Right now I'm standing here, my initial chunk goes here, and my salvage value at the end of the year, end of the project life rather. Now if I'm talking about the average investment, so we are saying that okay, after the 5 years, we will be getting we will be getting back some value. So we are netting that off in calculating the average. But since it will be at the end of the project life, it will still be remaining invested throughout the life. It will be still remaining invested because let's say if I'm getting a 100,000 here or a 1 lakh here, and the salvage is let's say 10,000. So that means this formula is telling me that my average investment is 1 lakh divided minus 10,000 divided by 2, which is giving me 45,000. But since that 10,000 is I'm getting at the end of the project, that 10,000 is still invested throughout the life. We are adding that 10,000 back to give it for 55,000 to get a 55,000. So I'm sure like some of you may find it a little difficult to digest though, but the logic I'm telling you why we are adding back the salvage value, because the salvage value is not, you're not getting salvage value till the last day of the project, till the last year of the project, terminal year. That's what you have to get the salvage value. So example here for everyone, suppose Cisco company is going to invest a project a sum of 3 lakhs, having a span of 3 years. Salvage value is 90,000. Profit before depreciation every year is 1,50,000. So we're talking about profit before depreciation. The first thing is we have to calculate the net income. So net income, mind you, forget about cash flows for next 2 minutes. And that's why this method can be criticized, that there are no cash flows being discussed here. So 3 lakhs is what my investment is. Salvage value is 90,000. Profit before depreciation is 1,50,000. So if I'm looking at the depreciation calculation, so if you're looking at a straight line method, we're saying 3 lakhs minus 90,000 upon 3, that is 70,000. So 1,50,000 minus 70 minus tax. So 80,000 is my profit before tax, minus 24,000 is what we are getting as a 56. So 56,000 is what I'm getting as an average or an annual return. Now, in this case, we are saying that a simple point that we are not talking about a working capital. We are just dividing the 56,000 divided by 3 lakhs. That's my overall investment. So 56,000 divided by 3 lakhs is what we are getting, 18.67%. Mind you, as I said, the denominator can have different variations here. Investment can be calculated differently. In the first example, we have taken the entire 3 lakhs. But let's say if we want to use the denominator as an average investment, then the same logic, half of 3 lakhs minus 90, then add back that 90,000, you'll get 1,95,000. Why? Again, the same reason I told you a couple of minutes ago. Salvage value, we are reducing and averaging the entire investment, but because the salvage is received at the end of the project, we are adding that back because that stays invested throughout the life of the project here. So basically, we are talking about a different version here. Now, with the same logic, I'm sure all of you agree with me that in fact, there are more than couple of disadvantages of this method. One is it's based on the net income. Net income is based on the estimates, accruals. It doesn't consider the relevant cash flows. B, the calculation of investment itself can be debatable. And C, we are not even talking about discounting of anything. We are absolutely ignoring time value of money. So absolutely, I would say a challengeable method, not so acceptable method. But let's say if you have a small question of let's say a 5 marks or something like that, right? Question is asking me in exam which method we should use for ARR. Question at most probably the question should mention that. But let's say if they have not mentioned, you can mention your assumption for putting the investment. Or if you have time, you can calculate both the ways, right? So what we are doing for calculating ARR here is we are just completing that previous example. We are taking the end calculating the ARR for every year separately here. Year 1, year 2, year 3. So 56,000 divided by 3 lakhs. That is my investment for the first year. We are not using the average investment in this method. 2,30,000 how? After depreciation. And then 1,60,000. So your ARR will keep on increasing because your investment is reducing because of the depreciation. And we are averaging out the here investment or overall ARR, right? We are averaging out the ARR to get a 26%. But yes, I absolutely agree with you that it's basically can be a debatable method. It ignores the time value of money. Net income can vary, and of course, cash flows are ignored. So just I think basic knowledge of this method and the basic formula should be more than enough. Don't spend hours on accounting rate of return. And this is just an advice based on the applicability and acceptability of this, right? Okay, so just give me a quick second here. Any questions till now, guys? Any questions till now from anyone? I hope all are doing good. So we can now move on to the discounted techniques. That's where we belong to, right? We cannot, in the present day world, we cannot ignore the time value of money. If I were to give you $1,000, would you prefer those $1,000 today or 6 months later? Simple question. Now don't tell me that I owe you 1,000. I'm just taking an example. If I owe you 1,000, would you prefer to get that 1,000 today or 6 months later? Simple question for everyone. I'm sure most of you will want money today as soon as possible, as soon as or as early as possible. We would definitely want that 1,000 today, right? Am I correct? Everyone agreeing with me here? Come on, guys. Need some confirmations here on the query panel. Yeah. So almost like Manish says right now. Give it right now. Forget about today. Give it right now. Very nice. So the discounting techniques consider the time value of money by discounting the cash flows to their present value. And what discounting rate will you use? You guys calculated with me only a couple of weeks ago using the WACC. Generally, the discounting rate would be the WACC itself. So what is net present value, guys? Net present value, simple formula, present value of the cash inflows minus present value of outflows. So generally, you may have only initial investment. So you can say initial investment. But let's say if you have outflows later on also, it's better to use present value of outflows. Akash has a very, very valid point. Akash says that I can actually accept 1,000 6 months later if you pay me interest. And Ruturaj is most practical of everyone. He's saying that I can give you my account number right now. You can transfer immediately. He said that these days Paytm Pay you can immediately transfer. Very, very nice, very smart. So very superb, guys. I think you guys will be very, very efficient chartered accountants. Superb. Okay. So very nice, guys. Thanks for your inputs, though. And I gave a disclaimer that I don't owe you guys any money, right? So you are trapping me in my own question. So, anyways, so the formula is clear to everyone. Net present value is present value of net cash inflows minus present value of cash outflows. Now, how do we calculate this cash inflows? We have already discussed, right? We talked about the cash flows had three stages, right? Initial stage, beginning, time zero, interim stage, and then terminal year. So you have different cash flows. So what happens is, those of you who have done capital investing before in earlier curriculums, you might remember something like this. So I may make different columns, year 0, 1, 2, 3, 4, 5. So we may have some investment here, some inflows coming in all the years, some additional investment here also, some salvage. You may have a working capital here. So you basically you make columns for different years and you calculate your cash flows for each year. Unless it's uniform for some of the years, it's a different ball game. You calculate the cash flows and then you multiply this with a present value factor. Each year can be multiplied with the present value factor to calculate the total NPV. So, can anyone tell me when we talk about overall evaluation, what should be my decision criteria using NPV? I think it's very straightforward. If NPV is more than zero, positive, then you should accept the project, right? Just checking the responses. Okay. So basically these are your steps. Net cash inflow in each year of the investment. You should know that. We learned that today. Your WACC would be given to you. And then for each period, you have to calculate the present value factor and multiply the present value factors and then add up all the amounts. So if I'm saying that if my NPV is more than zero, accept the project. If it is less than zero, let's reject the project. Manish, we will not be guaranteeing that. Manish says that why all the questions only have one initial cash outflow. You may have different questions coming in with additional outflows during the project. So logic will not change, right? So right now, on my screen, guys, there is a project here. Uh, and I guess everyone is pretty much good in terms of calculation. So we'll have a quickly look, and some of you may not be comfortable in NPV. This is a small, quick illustration for you guys. So NPV of a project with an initial investment, net investment of 1,20,000, and the cash flows for 3 years is given as 80, 70, and 20. Mind you, if there are uniform cash flows, in case of a uniform cash flows, I'm intentionally using the word inflows, you may use a present value annuity factor instead of using a present value factor. Which means sum of present value factors. So basically, you can use one amount and multiply with the sum of the factors, you will get the same amount. So here in this case, we don't have uniform cash inflows. We have 80, 70, and 20. And the cost of capital is given 10%. And present value factors is given as 0.909, 0.826, and 0.751. Provide recommendation, of course. So what we'll do is here, we will plot these cash flows. So initial investment is not discounted here. So that's 1,20,000. So what gets discounted here is nothing but your 3 years cash flow. So what I'm getting is a positive 25,560, and hence the project may be accepted. Just a small example of just seeing, how NPV gets calculated. Of course, We have already seen payback methods. There are good advantages in terms of payback comparing with the payback method. A, it's a time value of money is considered. B, entire life of the project, guys. We're saying entire life of the project is considered. That means here you are worried about the profitability also. All cash flows, even after the payback period, entire life of the project. So that means this particular point makes it a very, very preferable method. I think one of the most preferred methods because it is in line with the objective of wealth maximization because you are considering the present value of all the cash flows of the projects. But of course, in terms of capital budgeting decision on the first slide when we started at 6 p.m. today, we discussed that one of the problems in the capital budgeting decision is that in estimations, future is uncertain. So that's the problem here. Talking about it depends on the estimation of the future cash flows. One more thing, guys, it's uh it's an absolute measure. It ignores the difference in the initial outflows against various projects. So what happens is, let's say we talk about two projects here. This is outflow, right? Let's say project A is 2 lakhs and project B is requiring 6 lakhs. And let's say that we are looking at in terms of present value of inflows. Let's say we are looking at 2 lakh 30,000 and here we are saying 6 lakh 35,000. So you may see that, okay, NPV here is 30. You're talking about 35. You may go ahead in this case very easily that, okay, project B looks good. NPV is higher. NPV is higher. But what you may, overlook that, okay, project B is actually more riskier also. 3 times the investment. Are we getting 3 times the return? So the point is that we are talking about NPV as only an absolute measure here. It's an absolute number which is being considered. This drawback can be kind of tackled with a concept called as a profitability index. Profitability index, guys. That's one of the ways of calculating the or rather evaluating the projects. We also call it as a desirability factor, profitability index, which is nothing but a present value of cash inflows divided by present value of cash outflows or initial investment. So it's like for every rupee invested, how much you are giving it back. So that means whenever we are looking at different amounts of cash inflows or outflows, we will consider this. The decision criteria is same, right? If present value index is or profitability index is more than one, we accept it, else we reject it. But guys, for calculating, for comparing the two projects, this is what I'm trying to say. For mutually exclusive projects, project with a higher profitability index should be accepted. Like if you see this, coming back to my example, actually, coming back to my example, instead of a net NPV, if I were to compare profitability index of A and B, guys, how much I'm getting, right? 230 upon 200,000, I'm getting 1.15. Am I correct? For project A, but for project B, I'm getting 1.06. So if I'm evaluating this with a basis of profitability index, I'm saying that, okay, hey, project A looks good. It's giving me more returns. So it's not an absolute number. Everyone with me on this, guys? Profitability index is again a little better version of NPV, although it is based on NPV only. It's just that it is a better version of NPV because here we are talking about different investments of different sizes. One more example on your screen right now. One more project or one more example here. Two projects with discounted cash outflows, 1 lakhs and 1,20,000. Right? So let's look at this also. We are talking about a discounted cash outflow of 1 lakhs, 1 lakh 20,000, discounted cash inflows as 150 and 190. So we just simply divide and see that, okay, 1.5 for project A and project 2 is 1.58. So here the second project is preferred, right? So the best advantage here is that it's a relative measure. It's a relative measure versus absolute measure. It's not an absolute measure. Absolute is NPV, and this PI is a profitability index, is a more of a relative measure, right? But again, the advantage of NPV becomes disadvantage here. That I can give you another example. I can give you one more example where you might see that, okay, NPV is better. So let's look at this. Project A, project B. Let's talk about initial outflow, 2 lakhs, and we get 10 lakhs. Okay. And let's say present value of inflows given, which is a 2 lakh 50,000, and where we say 12 lakhs. Another example I'm kind of mentioning on the top here. So you have to be a good wise financial manager to decide, okay, which method should be used depending on, I think, Srinivasan says that you have to look at the budget constraints, other objectives, strategy mapping, and all. So here, what is the NPV, guys? 50,000, 2 lakhs. What is the profitability index? 1.25, 1.2. So I guess everyone agree with me that based on the profitability index, it seems project A, but based on the NPV, it's project B. And some of you might say that, okay, sir, if we have budget, project B looks good. It's giving handsome number in terms of absolute. It is giving you 2 lakhs in return. Again, so it all depends on other factors. It's the management objective versus budget in hand, alignment with the long-term strategy and all that. I hope everyone agreeing with me, understanding with me when I'm comparing both the methods, NPV versus PI. Everyone okay, guys? Can I get a confirmation here? I think both of them are interrelated in terms like one is A minus B, other is A upon B. So NPV is an absolute measure. It's calculated as a numerator upon denominator, an numerator minus denominator, and profitability index is a relative measure which calculated as a numerator upon denominator here. Okay. So let's do one thing, guys. Before we move on, I think time for some brain teasers here. So let's see who answers these questions correctly. So we have question number 1 and 2 on your screen. My request is before you answer or when you answer, please mention the question number along with the option. Please mention the question number along with the option, whatever you're giving. So let's say you're giving for 1, you're giving C. So mention 1C. I think very nice. Everyone is pretty much straightforward in question number 1. So the methods which we are mentioning here, I think some methods we are yet to discuss like IRR, modified IRR, but you guys are absolutely spot on that of whatever we have discussed till now, it's definitely a payback method, which is not a discounting technique, and hence it's the right answer. Okay, so what is question number 2 talking about? Question number 2. I think some people are confused in terms of a couple of options till now. In fact, I later on realized that some people for question number one also mentioning some other options. Kiran and Mamta, I think we don't worry, we are yet to discuss the modified IRR. So don't worry about that. But the majority of the Janta is kind of telling me to A or B. To A or B. That's where the confusion is. So let's discuss this question now. So we are saying here is, guys, in case of a company considers a discounting factor higher than the cost of capital for arriving at present values, then the present value of cash inflows will be high or low. See, guys, when we are discounting now, we are multiplying a cash flow into 1 upon 1 plus R. So if I increase the R, don't you think the amount will come down? The discounted cash flows will come down. It's a mathematical answer, right? If you are discounting with a higher number, the discounted cash flows will be lesser. I think this is before the break. We discussed when we were talking about cash flow versus payback versus discounted payback, right? I hope everyone understand this. Correct answer is A, not B, guys. You're discounting with a higher number. Dividing with a higher number will give you a lesser number, a smaller number, a lower number. That means what we are saying here is that this is absolutely option number A. All okay from everyone? Super. Very nice. Okay, guys. Time for a quick practice question here on the NPV front. On an NPV front, and let's talk about this. Okay, so you guys can see a question on my screen right now. So, quick question for NPV perspective, and I want you guys to quickly work around some of the factors. So, the company here is considering MTR Limited is considering buying a new machine which would be having a useful life of 5 years. Cost is 25 lakhs. Scrap value of 3 lakhs with 80% of the cost being payable at the start, 20% at the end of the first year. So I think Manish, here you go. I think some people are asking me about when the cash flows, outflows can be spread across. This is a good example. Machine would produce 75,000 units per annum of a new product with an estimated selling price of 300. Direct cost is 285. And annual fixed cost, including depreciation, would be 840,000, 8,40,000. Mind you, it's including depreciation. How much is the depreciation here, guys? Can anyone tell me depreciation? How much depreciation would be charged here? They're saying depreciation is calculated on straight line basis. So you have a 25 lakhs value. Scrap value is given as 3 lakhs, and the life is how much? 5 years. I am getting a depreciation of 4 lakh 40. I don't know about you guys. 4 lakh 40,000 depreciation. Can you guys please confirm? So everyone getting 4 lakh 40,000 as a depreciation, right? Now that means if I were to say that, okay, my total fixed cost including depreciation is 840, can I say that means 4 lakhs is my cash fixed cost? Because 8 lakh 40 may say 440 is depreciation, 4 lakh is a cash fixed cost, right? Additional information is given in the first and the second year. Special sales promotion expenditure not included in the above cost is 1 lakhs and 1 lakh 50,000. So it's a classic case where outflow is spread, guys. Initial outflow be here. Year one outflow is also there. Year two outflow is also there. So what we have to do is we have to calculate the project's NPV assuming the cost of the capital as 14% here. Now, what's happening here is, in this case, if we plot down the same information in the tabular format which I was referring to earlier, my initial focal point is on the outflows. I'm initially having a cash outflow of 20 lakhs. Mind you, how do we calculate 20 lakhs? 80% of 20 lakhs is immediately, and 20% of 25 lakhs is after 1 year at the end of the year. So 5 lakhs is coming here. So 25 lakhs is spread into two, 20 and 5. And special sales promotion, which was given in the last slide, is also mentioned as an outflow year 1 and 2. But what we need to consider is how much cash inflow we calculate. Here you can see 7,25,000, but we need to consider how do we arrive at this 7,25,000, right? The best part is some people may have noticed this. The good news about this question is that they have mentioned ignore tax for this illustration. So tax saving of depreciation is not even a concern here for us. What we know is the selling price is 300. Direct cost is 285. So we are getting a 15 per unit of contribution. 75,000 into 15 is how much? 11,25,000. That's the contribution you guys are getting. And minus cash fixed cost. Minus cash fixed cost, which was 4 lakhs, right? So that's how I'm getting a cash inflows of 7,25,000. Is everyone with me on this? We are calculating the annual cash inflows here. I hope everyone is aligned on 7,25,000. Because if you are aligned with me, rest is history, right? Just plot the numbers. So we plotted 7,25,000 in each of the years. Mind you, in the terminal year, there is one more cash flow. The sale value of the machinery of 3 lakhs. That's a scrap. That's a scrap here. So we add up all these cash flows, what we have calculated here, including outflow and inflow. We end up having a total cash flows of the respective years. And then we were asked to discount with the 14% discounting factors. Tanishka says, why 4 lakhs was minus? Tanishka, because it is a cash fixed cost. Now you're calculating the cash flows. So cash flows will be based on all out of all the cash outflows have to be reduced, right? So your selling price is 300, Tanishka. Direct cost, which is a variable cost, is 285. I calculate a contribution of 15 per unit. 15 into 75,000 is contribution of total 11,25,000. But out of the fixed cost of 8,40,000, there is a cash fixed cost of 4 lakhs. Tanishka, that's what we discussed now. Excluding depreciation out of 840. You have to minus because it's a cash fixed cost, cash outlay. It's a cash outflow. So my net savings is 725 in cash. Okay, guys. So then we are multiplying these cash flows. We are multiplying these cash flows with the discounting factors here. Every year cash flows total, whether it is inflow or outflow, total cash flows will multiply it with the respective discounting factors. And we add them up to get a positive NPV of 3,000 something. Don't worry about the fractional differences, guys. Don't worry about the fractional differences due to rounding off or whatever. So NPV is 3,000 plus, which is anyways positive. I'm happy. I'm having a smiley face. I will say that project can be, accepted here. Bandi has a different question. Why we are not taking sales expense in year 2 and 3 and year in cash flows? Why would we do that? Year 2 and 3? They're talking about, please read the question carefully. In the question, there is a specific line, right? In the first year and the second year, it is given to us. Why would I take in second and third? first year and second year. Hmm. So Bande, I hope it is clear. It is like clearly mentioned to us. Everyone okay here? You need to read the question carefully. Confusion is because we need to be pretty sure that we read the question carefully. Who all are comfortable with the calculation, guys? Any doubts in any other point? Tanishka, Ashok, Sushil, Parmisha, anyone, guys? I can't just call each one of your names, but just quickly checking Srinivasan. Yes, thanks. Anmol says, after calculating the present value, how do we calculate NPV? So NPV is what? Present value of cash inflows minus outflows. We have added all the inflows and outflows together. So what we have done is, Anmol, what we have done is we have added these numbers, na? Minus 20 lakhs plus 1 lakh 9,000 plus 442. We have added all them. Or you could do is, just add the present value of inflows to one at one place and present value of outflows separately. It's one and the same thing. This is a short, like it's a time saving method because otherwise you will be calculating the present value two times. Inflow separately, outflow separately. It's better to combine the cash flows for respective years. And that's what we discuss in the steps, right? First one is net cash inflow in each year of the investment. The word was net cash inflow. So that means if there was any outflow also, you can net that off. Yeah. Hmm. So yeah, I agree with Harmisha. Harmisha says that was a pretty easy one, very easy one to go ahead with. Okay. If this was an easy one, let's kind of find out something that can be very interesting in terms of overall factors. So let's go to another quick question on the NPV front is on your screen right now. I want everyone to be pretty much going through the information here quickly. So now Jeevani Hospital is considering to purchase a machine for medical projectional radiography, which is priced at 2 lakhs. Okay. So 2 lakhs is the price here. Projected life of the machine is given to us 8 years. Salvage is 18,000 at the end of the 8th year. Annual operating cost is 22,500. It is expected to generate revenues of 1,20,000 per year for 8 years. Presently, now this is important. Presently, there is something happening that hospital is outsourcing the radiography work to its neighbor and is earning commission income of 36,000 per annum net of taxes. Wow. I am thinking of one thing which we discussed in the first slide, guys. I don't know how many of you can recollect. There was a term which some of you asked also, what is the meaning of this term? If I start to do, if I start to do this radiography in-house, I purchase the machine, will I be earning this commission of 36,000? Yes or no? If the answer is no, what do we call this 36,000 as? I used a term for this when we were discussing the relevant cash flows for the project at almost 6:30 p.m. Am I correct or am I correct? So let's see. Harmisha is always on the top of her game. She says it's clearly called as an opportunity cost. Superb. This is an opportunity cost. We may have to consider this because we may not be learning or we may not be earning that, not learning. So Gajendra, Ninad, Nikita, Rituraj, absolutely perfect. Manish, Srinivasan. So I'm pretty much glad, guys, that today you guys are superb as always. Like I think I'm sure you guys are superb in all the sessions, but my experience is that you guys are always responsive. So analyze whether it could be profitable to the company to purchase the machine. Give your recommendation either under the net present value and under the profitability index also, both. So if we were to consider this, guys, 36,000 is an opportunity cost, very, very rightly said. But if I may ask you guys, what is the cash inflow after tax? Can anyone quickly tell me the numbers? Calculate it your way, guys. Very, very quickly. You guys can do it in a calculation, in a calculator also. What is the cash inflow after tax? Method one. Method one. I am getting a annual operating cost of 22,500 and revenue of 120. So 1,20,000 minus 22,500. And what is the depreciation here? Depreciation is how much? We can probably note down the depreciation also here because you will have a tax shield of the depreciation, obviously. So my depreciation here is 2 lakhs minus 18,000 divided by 8. 22,750, right? So that's a depreciation. So I got one answer from Ruturaj is 68,250. Very nice. Some people say 75075. Ruturaj changed his answer. Okay. Or probably you gave me a different answer earlier. Sajendra has a different answer altogether. Okay. So if I want to calculate method one, I would say that revenue I am getting here is 2 lakhs. No, not 2 lakhs, 1,20,000, right? So we're getting a revenue of 1,20,000 minus operating cost is 22,500. So that is giving you of a 97,500 as an operating profit before depreciation. But if you also reduce the depreciation here, 22,750, you're getting 74,750. That's what I can see some numbers here. Minus tax, have they given a tax here? Tax percentage, 30%. So minus 30%, I'm getting amount of 52,325. 52,325. But you guys are absolutely correct. We have to add back the depreciation also. So 22,750 gets added. So we get 75,075. But mind you, once you get 75,075, you also have to consider that there is an opportunity cost. So you have to reduce that also. Opportunity cost has to be reduced of 36,000, which is already net of tax. So I think most of you got this answer 75,075. You have to reduce the opportunity cost also. That means what you are getting is 39,075 here. I think everyone is with me till this point. 39,075. After reducing the opportunity cost, please. That's also cost, right? It was given net of tax. So 39,075. Everyone is with me on this? All okay, guys? So that means if I have to quickly calculate in terms of the present value calculations from years 1 to 7, I'm looking at the right hand side table now. I'm saying that from year 1 to 7, my cash flows after tax is 39,075, which I multiply with the present factor to get 1,90,000. And then in year 8, we are getting 39,075 plus 18,000 salvage. So we get a 57,075, which we multiply with the present value factor. Now this is a present value annuity factor, and this is a present value factor for 8th year. So which is giving me 26,654. That means total is 216. Outflow is 2 lakhs. That means my NPV 16,832. Yes, no. So Gajendra, it depends where do you fit that. So Gajendra says, what if the opportunity cost was not given net of tax? So I would have done 36,000 into 70% because I would have paid tax also, right? So I would say 75075. Gajendra, this is only in response to your query. I would have done 75075 minus 36,000 into 70% if it was not net of tax. But we are not considering this right now because we are given that. Okay. So guys, I guess one thing you guys all agree with me is whether we talk about an NPV or a profitability index, both will give the same evaluation, right? In terms of only one project. If NPV is positive, PI will be more than one, right? All okay with that conclusion here? If NPV is positive, the profitability index will always be more than one. So in terms of a single project evaluation, both will give the same result. Mamta is asking me, just like depreciation, do we need to add back the salvage value? No, salvage value is anyways added in the last year, Mamta. Okay, so very nice, guys. So I think we have done two good examples on NPV, and we are on to the last 10-15 minutes of the day. So let's kind of move our focus to the another important method, just like NPV, is your IRR, internal rate of return. I guess smart students here, which all of you are, would remember that IRR I have already touched base on somewhere. Who will tell me where did we discuss IRR? And I told you that we'll be touching bases again in capital budgeting. Who remembers calculation of IRR, guys? We have done 30-40% of IRR already. Anmol says cost of capital. There was a question coming in from Mamta. Why the salvage value is considered here? Mamta, because eighth year it will be inflow. Rituraj says cost of capital. Harmisha says cost of capital. Remember cost of capital mein YTM method. YTM method for debt, right? Where we used to calculate two NPVs, one positive and one negative. That's what the IRR is. So IRR is a method at which the NPV of a project is zero. So IRR for an investment proposal is the discount rate at which the present value of expected inflows equals the initial investment or present value of outflows. That means is that rate where NPV is zero. Is that rate where NPV is zero? And what we can do is we can compare. How do we evaluate a project? We compare the IRR with the desired rate of return. Now that is what we need to consider, guys. I'm telling you very, very simply. Some people say that, okay, sir, if IRR is more than my desired rate of return, you should accept the project. If IRR is less than the desired rate, you should reject the project. This is a simple calculation, but I have another point to it. I have a mathematical angle behind this criteria. Why do we do this? I want your inputs quickly. I want everyone super active in the last 10 minutes, please. Super active. Drink Bonvita, eat Chamanprash. Just be super active in the last 10 minutes. Please tell me the first scenario here on the top, which says IRR is more than desired rate. I'm talking about the first scenario. What is IRR? NPV is zero, right? That means what will be the NPV at the desired rate? If the desired rate is lesser than IRR, the NPV will be positive, yes or no? NPV will be positive, yes or no? And hence we accept the project. Hence we accept the project. It's a mathematical way of looking at things. How many of you agree with me? I'm talking about the scenario A. If my IRR is more than desired rate, you guys agree that IRR is the rate where NPV is zero. So, bhaiya, desired rate is a smaller rate at which NPV will be positive automatically. I'm looking at your responses. Similarly, in the second scenario, if IRR is, let's say IRR is 7% and desired rate is 9%, at 7% NPV is zero, but at 9% NPV will be negative. Higher rate, your cash flows will further reduce. And negative pe we anyways reject the project. So I'm telling you both the sides of evaluation here. Make sense, everyone? Now, one thing I'd like to talk about here is how do we calculate IRR? Although we have done it YTM method, let's look at once more quickly. If I have uniform cash flows here, if I have uniform cash flows, it's a simple thing. We will do that, okay? We understand that IRR, present value of inflow, is equal to present value of outflow or initial investment. And if we have uniform cash flows like same amount every year, we can just simply do that, let's say same amount is A into 1 plus R to the power 1 plus A into 1 plus R to the power 2, and so on, will be equal to the initial investment. So that means if we kind of take that A outside, what we can multiply is that initial amount, that same inflow can be multiplied with the present value annuity factor. Because mathematically I can take A outside, and what I'm left with A into 1 plus R to the 1 plus R square, and similarly 1 plus R to the power n. So what we have in the bracket is present value annuity factor. So if there is a uniform cash flow, we can simply say that, okay, annuity factor into annual cash flows is equal to initial investment. Hence, annuity factor is simply obtained by dividing the initial investment by annual cash inflows. And then you can check the annuity table. You can check annuity table. If you're getting a specific rate, at what particular rate for a particular duration, that factor is there in the annuity table, and you can calculate the IRR. But the problem is, are we so lucky? Are we so lucky that IRR would be that rate that corresponds to a particular rate in the annuity table? What if it doesn't match? My problem is, there are two problems here. What if the rate I am getting, the present value annuity factor, doesn't correspond to any rate? It is between the two rates. That is one problem. Second problem is, what if I did not have uniform cash flows? In that case, you have to calculate IRR using the method we discussed in YTM. We need two NPVs, one positive, one negative. We need two NPVs. We need two NPVs, one positive and one negative. In case of uniform cash flows, you have two rates automatically because your present value factor would be between the two rates in the annuity table. But in the case of where the cash flows are not uniform, you have to take random two rates. You have to take random two rates. You have to see if at the first rate my NPV is positive, then the second rate will have to be higher and vice versa. Because you need two NPVs, one positive, one negative. Once you calculate the two NPVs, you will be applying the same formula which we learned earlier. Lower rate plus NPV upon lower rate, NPV at lower rate upon the difference between the two multiplied by differential. Only thing you guys remember is, in this formula, the denominator will automatically result in addition. Why? Because NPV at higher rate will be negative. Minus minus becomes positive over there. Make sure you remember this. The denominator will result in a positive here. Denominator will automatically result in an addition. NPV at lower rate minus NPV at higher rate. NPV at higher rate will be negative. That means it results in a higher amount. I'm sure some of you remember the YTM method. Some of you may not remember YTM method. That's pretty much fine with me. What we can do is we can quickly look at an example here so that you guys are clear before we leave for the day. Let's look at this example, guys. The example which talks about the Zebra Limited. So the Zebra Limited is evaluating a project with a capital outlay of 10 lakhs. Annual cash inflows of 2,50,000 for 6 years. Very, very nice. Very nice. We get uniform cash flows. Assuming the scrap value is nil, determine the IRR. So what is my annuity factor here? We have to straight away divide the initial outflow by the annual annuity and we get a annuity factor of 4. What are we getting here? Present value annuity factor. And what is the life of the project, guys? What is the life of the project in this case? It's given in the question, right? So life of the project is given to us 6 years. So what I'm doing is I'm showing you an abstract of the annuity table on the right hand side. On the right hand side, you see abstract here where you are seeing in the 6th year row. This is the 6th year period. I'm seeing 4 is falling between these two numbers, right or no? My IRR seems to be between 12% and 13% because I'm not getting 4 as an exact annuity factor. But I'm getting between 12% and 13%. At 12%, the present value factor is 4.111. At 13% is 3.998. But I also know that 4 is more closer to this number. That means my IRR would be closer to 13%, not 12%. It will be definitely more than 12.5, very close to 13%. Harmisha, yes. Otherwise, in the next tomorrow we will discuss also, how to quickly calculate a annuity factor. Like mostly they will be giving you the annuity factor. God forbid if you do not have annuity factor, it's 10-second job on a calculator using 1 divided by 1.1 and then use the grand total function. Okay, so guys, everyone clear on this particular example here? My IRR happens to be between 12 and 13%. So what we need to do is we are calculating the NPV now. We calculate the NPV at 12%, 2,50,000 into 4.111 minus 10 lakhs, giving me a higher positive NPV. And the higher rate will automatically give me a negative NPV. So I got the two NPVs, and when I apply the same formula, I'm getting what is the IRR? I'm getting 12.98. This is what my original anticipation. It's closer to 13%, guys. Closer to 13%. Yes or no? Everyone with me on this, guys? This example is clear, I believe. But this is a rosy picture, right? This is a rosy picture where you had a uniform cash flows. What if we do not have a uniform cash flows? You know the answer here. I don't need to tell you. If you do not have the uniform cash flows, you have uneven cash flows. What you need to do is you have to pick first rate as a random rate. Any random rate. Pick your favorite number, 8, 7, 6, 10, 15, 20, whatever. And then your second rate will depend what was the result of the first rate. If the result of first rate is positive NPV, then you have to pick a higher rate. If it is a negative NPV, you have to lower down the second rate. Second rate will depend. Second rate will depend, and then use the same formula, right? Lower rate plus NPV at lower rate upon differential into rate differential. So this formula should be close to your hearts. The formula at the left bottom of your screen. This formula everyone needs to know, guys. Make sense? Everyone doing good? And we already discussed the evaluation, the acceptance rule. I explained to you. IRR is more than WACC cutoff rate, accept the project because you will have a NPV positive at a lower number and vice versa. So I think with that, we would like to call off for the day. I think it's almost 8:35. We can stop here. We anyways have a back-to-back session tomorrow. And we look forward to a lot of practice. Few things from a concept standpoint will also be discussed tomorrow. I think we'll talk about the modified IRR. One method is kind of there. Then we will also discuss scenarios, guys, like where the NPV and IRR have a conflict. We will also discuss where we have a capital rationing situation, and we do a lot of practice. So I think what we'll do tomorrow is guys, we will talk about concept in the first half and some question in the second half. Just a quick thing that the same PDF have been uploaded for a reference in advance, and there are a lot of questions. Then what we'll be discussing in the class, those are for your practice. Intentionally, I've kept a lot of questions over there in that file, so you can do the questions which we may not be able to cover here as your homework or as a practice. But I'm pretty much thanking you all once more for amazing evening. I think you guys make my evenings, and I'm sure you guys all enjoy these sessions. Absolute fantabulous participation, and this proves that you guys are doing a lot of hard work, and that will definitely pay back very much. We talk about the payback period, the hard work will pay, right? And I think one thing I have always, you guys know that, right? Secret that we have already always discovered, that the practice makes men perfect, but it also makes women perfect. So it's like the three golden rules of success: practice, practice, and practice. So please go back, relax for some time, have your dinner, but then tomorrow before the class, do some practice for IRR and NPV related questions, guys. You have this PDF, you can practice some questions in advance, and then tomorrow we will divide the class in two parts, some remaining concepts first, and then we will do some practice, guys. So thanks a lot for your participation. Take care. Happy learning, guys. Keep on doing the good work. Good evening, good night. Take care. See you tomorrow. Cheers.